Welcome to this explainer. Marvell Technology is dropping its earnings in just a few short hours. And let me tell you, this isn't your run-of-the-mill quarterly update. We're looking at a massive, pivotal moment. Literally billions of dollars in market value are hanging in the balance today. The stakes are absolutely sky high, and the whole market is watching, just holding its breath. So let's jump right in and unpack exactly what's on the line here. To really get why Marvell is in such a massive pressure cooker right now, we've got to rewind just a bit. This stock went on an absolute tear recently, a staggering 170% rally. I mean, this was pure, unadulterated momentum. Investors were buying into this phenomenal growth story, essentially treating Marvell as the ultimate pick-and-shovel play for the whole AI and ChatGPT gold rush. The chart just went completely parabolic. Everyone from retail traders on up to massive institutional players, they all wanted a piece of the hardware that's actually powering the AI revolution. But as we know, reality has a way of biting back, and it bit back hard. Right after hitting that dizzying peak, the stock took a brutal 50% nosedive. Think about that kind of whiplash for a second. We're talking extreme stomach-churning volatility here. And it perfectly captures this intense tug-of-war happening in the market right now. You've got the massive AI hype on one side, and then the cold, hard reality of execution on the other. Traders sort of woke up to the fact that this AI windfall, it doesn't happen overnight. There are real-world supply chains, manufacturing bottlenecks, and really long integration timelines to deal with. And sitting right smack in the middle of all this wild volatility is one massive number. $12.2 billion. That's the reported size of Marvell's custom chip deal with Google. Just to put that absolute behemoth of a contract into perspective for you, that one single deal is worth significantly more than Marvell's entire global revenue from last year. It is a staggering commitment. And honestly, it's the main reason the stock has seen such wild swings. It's the ultimate high-stakes setup, bringing us into today's earnings event. So here is our tactical playbook for today's explainer. First, we'll look at the AI chip referendum. Second, pacing for perfection. Third, the Google deal elephant. Fourth, the bull versus bear case. And finally, number 5, the action plan playbook. Let's get to it. Starting off with part 1, the AI chip referendum and the incredibly high stakes for the AI trade as a whole. The really crucial thing to grasp here is that this earnings report isn't just about Marvell operating in a vacuum. The broader market is treating this as a literal referendum on the entire AI chip trade. If Marvell shows any unexpected weakness, it's going to cast a dark, heavy shadow over the momentum of the whole sector. You might be wondering, why Marvell specifically? Well, it's because their custom chips sit right at that critical intersection of data center networking and custom compute. They're providing the essential plumbing for the AI revolution. So investors are using this single report as a massive temperature check for the health and sustainability of the entire global AI hardware ecosystem. Moving to part 2, pacing for perfection, and the shockingly high bar set for Q3. The sheer scale of expectations here is just staggering. Let's break down the numbers. The consensus for Q2 is hovering right around 93 cents for earnings per share, with revenue at $2.71 billion. Now, that represents a very solid 35% year-over-year growth. Not bad, right? But looking ahead, the market is aggressively demanding a Q3 guidance target of $3.03 billion in revenue. If they guide anywhere below that $3.03 billion mark, you need to brace for a sharp sell-off. But if they somehow manage to project above $3.1 billion, that is pure rocket fuel for the bulls. Why? Because blowing past that $3.1 billion mark shatters those ultra-bullish whisper numbers that elite institutional investors have been quietly circulating. And that right there perfectly illustrates why forward guidance is so absolutely critical today. Marvell is currently trading at a price-to-earnings ratio of roughly 83x. Think about that. They are quite literally priced for perfection. When your valuation is stretched that tight, just beating past earnings is absolutely not going to cut it. The market is paying a massive premium for future growth. That means Marvell desperately needs to raise their future guidance just to justify this multiple. There is literally zero margin for error here. One little stumble, one slight miss, and gravity is going to take over instantly. That brings us to part 3, the Google deal elephant, and the market's desperate search for near-term proof. We talked about that huge $12.2 billion headline with Google a minute ago. And yeah, it's a fantastic, visionary, long-term story that stretches all the way out to 2033. But here's the rub. Traders want proof right now, today. Wall Street operates in grueling 90-day quarters, right? Not 10-year visionary timelines.
The market wants execution details immediately. People are asking, what are the exact shipping timelines? What are the attach rates for networking and storage? And how exactly is this warrant structure laid out? Any kind of vagueness or dodging of these specific questions on the earnings call is going to be treated as a massive red flag. Investors right now have absolutely zero patience for a just trust us narrative.
Let's ground ourselves in a recent technical reality of this stock, because, man, it has been a wild ride. The price peaked at roughly $330 back in June and then violently crashed down to around $163. Right now, it's clawed its way back, recovering about 49% to sit near $245. And if you look at the options market today, options are pricing in a massive 11 to 13% price swing immediately following this report. To put that into perspective, we're talking about a multi-billion-dollar swing in market cap happening literally overnight. The market is fully strapped in for some extreme turbulence. Because of all that, you absolutely have to know your technical levels. On the downside, we're watching support at $220, which was a recent breakout level. And below that, you have the major psychological floor of $200. Now, looking at the upside, resistance sits at $265. That's the post-crash high. And above that is $290, which is the average analyst price target. So keep these zones mapped out clearly in your head. Think of that $200 floor and that $290 ceiling as the vital guardrails for this whole earnings event. All right, part 4, the bull versus bear case. Two completely different views on Marvell. It's honestly fascinating to see the institutional divide on this one. Over on the bull side, championed by firms like UBS and Jefferies, they are incredibly optimistic. They see this Google deal as totally transformational. They firmly believe data center growth is sustainable, and they're fully expecting FY 2027 targets to be raised. But then you flip to the bear side, with folks like Morgan Stanley and TD Cowen sounding a much heavier alarm. They're arguing that expectations are just way too high right now, the valuation is dangerously stretched, and they're warning that even a slight guidance miss could trigger a brutal 15 to 20% drop. Neutrally speaking, this is a classic high-risk, high-reward setup. But with that massive valuation in play, the risk-reward ratio is undeniably skewed to the downside if the guidance isn't absolutely spectacular. Which leads us perfectly into part 5, the action plan playbook, mapping out the specific outcomes. Let's run through the if-then logic so you know exactly how the different scenarios could play out. Step 1. If they beat and raise guidance, look for a swift move toward that $265 to $280 range. But the playbook suggests waiting for a pullback. You really don't want to chase that initial emotional spike. Step 2. If they just meet expectations and guide in line, expect a classic sell the news drop down into the $220 to $230 support zone. Now, if you genuinely believe in that long-term 2033 story, that drop might actually be a strategic buying opportunity. And step 3. If they miss, honestly, all bets are off. That $200 support becomes hypercritical. The rule there is super simple and it's essential. Avoid trying to catch a falling knife. Ultimately, you have to trade the reaction, not the hope. The overarching AI narrative remains fundamentally intact, for sure, but there's no denying this specific stock has run quite a bit ahead of its tangible fundamentals. This event is a pure game of execution. It demands strict, emotionless discipline from anyone involved. You literally cannot trade this based on what you want to happen. You have to trade what the tape is actually telling you. I want to leave you with this final, really powerful thought as we head into the print. The market rewards clarity and punishes ambiguity, especially during earnings season and especially with an 83x multiple hanging over their heads. Marvell simply cannot afford to be vague. So, the multi-billion-dollar question remains. Will Marvell cement its status as a foundational pillar of the AI revolution, or is this the moment the hype train finally derails? Keep your eyes on the tape. Thanks so much for joining me on this explainer.